Good morning and welcome. Thank you for joining us today. My name is Josh Bath. I'm a realtor with Keller Williams Elite Realty. And today we're presenting a really exciting topic, financial management in a pandemic with Barry Trischuk. I'd like to introduce our title sponsor for today's webinar, Endurance Financial Services. Now, Barry's got a lot of really good information to share with you today, and no doubt there's going to be a lot of questions. We will open up the Q&A box at the bottom of your screen at the end of his presentation, and we're going to do our absolute best to get to everybody. Now on to the main event. Barry Trischuk is the founder and principal of Endurance Financial Services, an independent financial services firm based locally out of Vancouver, BC. His approach to financial planning is a holistic perspective. Barry demonstrates on how creating wealth requires more than selecting investments and including thorough consideration of risk, cash flow, estate planning, and tax management. This enables Barry's clients to be positioned to manage volatility while capitalizing on growth opportunities. Barry serves as a committee member of Avacus, the Financial Planning Association in Canada. Through his involvement, Barry works to improve access to financial resources for Canadians by collaborating with other financial advisory practices and industry partners on educational advocacy initiatives. His credentials are impressive, include a Bachelor of Commerce from the University of Saskatchewan, as well as a certified financial planning planner. He's a chartered life underwriter and certified health insurance specialist designation. I'd like to now welcome our main host, Barry Trischuk.
Good morning, everyone. Josh, thank you so much for that very, very kind introduction. It is so great to be here this morning and to see so many people in attendance for the session today. And thank you as well to the Real Estate Board of Greater Vancouver for taking interest in doing a session on this topic and for inviting me here today to speak on it. So before anything else, a shout out, as I'm sure we've all been doing, to our essential healthcare workers in healthcare, as well as civil services, other essential services who've really kept us afloat over the last 2 months. I know that many of us have spouses or children or even parents that have been working very diligently over this time, and from myself, thank you very much. So with that, let's get right into it. Now, a disclaimer before I get started. I wish I could give you a magic recipe or formula or 5-step program that's going to guarantee you anything over the next month, few months, or even the remainder of the year. Right now, while things are starting to normalize somewhat, a lot of caution that there's still a degree of uncertainty, economic uncertainty, cautions around what the second wave might mean for us. So we still may be in for a bit of a ride, and I would be weary of anyone or anything that's telling you anything with any uncertainty as we look ahead. The other thing maybe to keep in mind is this is not our last financial crisis. So this is, for many of us, not necessarily the first one that we've lived through. And unfortunately, it is not going to be the last one. So, you know, maybe if nothing else, how can we learn from this experience, and how did we use our time to make sure when the next one happens, how well positioned are we going to be to navigate that when it comes along. So there's my disclaimer in setting a bit of a stage. On a more positive note, as we've heard the phrase before, perhaps this too shall pass. Eventually we will be on the other side of this. The question being, you know, how will you be ready? What is that going to look like? And really, maybe how have you utilized the time up until now, and how are you utilizing your time right now? So what I've heard from a lot of people, you know, so if we don't have necessarily an opportunity to work in the business, are we working on our businesses? I've heard from so many self-employed people and entrepreneurs who are, you know, if nothing else, trying to be thankful for this time, to saying, you know, it's given me an opportunity to take pause, focus, do some things that I've always kind of put off that I know are going to elevate my business to the next level. But I never put that time aside to make those things happen. And I mean, really, what other choice do we have than to maybe look at this time as that opportunity to get some of those things done. So when things change and as they are unfolding, maybe there will be new opportunities. And so thinking from a broad-based perspective about your business in the industry, you know, if we look out over history from other times of either economic uncertainty or whatever, like new businesses and ways of doing business emerge. Are we being attuned to those? Are we being mindful of those opportunities? And maybe are we going to be able to incorporate those into our businesses and emerge from this maybe stronger than when we went into it? So just a thought-provoking sort of exercise there to be like, okay, how do I want to be presented? How do I want to be positioned when we move forward? So for what we're going to digest today, I was asked to spend some time speaking on cash flow and expense management. I think for some of us, this is an area of focus and concern right now, and understandably so. So with that, I'm going to get into a little bit of back to basics around some budgeting, which might be a refresher for some of us, but for maybe some of you, you'll be able to take away some new actionable practices that you can implement both in not just your business, but in your personal financial management. For people who are maybe looking for something a little bit more today, that will come further along in the presentation, as we're going to be talking about some further planning considerations around risk, investments, and we're going to touch a little bit on our friend tax as well. So I am covering a lot of content today, and I might not be able to get into as much specifics as maybe warranted as we would like today. But that being the case, at the end of the presentation, the final slide will be my phone number and my email address, which you are welcome to utilize and reach out if you want to dive into anything more intensely on a one-to-one basis, or maybe bounce some thoughts off of me in terms of, you know, we talked about this in the presentation. Here's my situation. Do you recommend anything? So would be happy to have those discussions with you. So when we think about where we're headed, when we're going moving forward, now if you caught it earlier, you might have heard that I received my bachelor's degree at the University of Saskatchewan. So it really should be no surprise that I have a visual of curling here. Because as many of you know, curling is literally the best sport to watch on television. I can't think of a more exciting 4.5-hour afternoon than watching curling. And for those of you that have watched curling, you might have noticed that there's a lot of strategy and planning involved. It's not necessarily throwing a bunch of stones down to the other side and hoping for a result that's beneficial for one team or another. So what we can take away from that is, you know, the importance of planning can also apply to ourselves, in that if our goal might be debt reduction, we're going to need a plan. Maybe your goal right now is a specific retirement lifestyle, and I want to retire by a certain date. Well, what's the plan behind that specific goal? If you own, at this point, you own multiple real estate properties, and you're thinking, you know, I would really like to preserve these and pass those on to my children as beneficiaries, or maybe even as a charitable or social cause. What is the plan behind actually executing and making those things happen? So with where we're at today, all we can do is take the information we have and implement it. Review as things change. Like I said, we don't know what could change. Things could change in a week's time, and we might need to make some changes and revise and repeat. So let's get into some considerations around the cash and expense planning. There's a phrase that is floated around, says cash is king, but okay, in my time, I've only seen one monarch on our currency, and it is this lady right here. So I like to say cash is queen. And maybe if we think of one quote or nugget that we take away from today, and I really, really believe in this, and that we cannot manage what we do not measure. If budget and cash flow is your focus right now, this is something that we need to be paying the most attention to more than anything else. The success and failure of businesses, both large and small, is often can be traced back to how good the cash flow is or was. And even now, whether it's a financial statement analysis that a stock investor is doing, or a lending institution that's evaluating a company for a loan, one of the first things that's going to be asked is, how is the cash flow? So again, large or even a small entrepreneur, sole proprietorship, individual basis, how well do we know our cash flow? How healthy is it? So this is so key to making sure you have both a successful but also a sustainable business that's actually going to achieve what it's aiming to get to. And this is such a fundamental piece of financial planning, whether it's business or whether it's personal. And yes, we know we need to budget. Yes, we know we need to do our dollars, but unfortunately, it's understood, but in practice, it's rarely routine. So if you don't have a plan for your money, someone else will. If you are not planning and managing your own money, someone else is doing it for you. In one light, we might look at that someone could be Apple, BMW, Amazon. We are inundated with those messages every day. There is no shortage of airtime to tell us what to do with our money. And we can get easily carried away with that, if that might sound familiar to some of us. So that, our plan is being dictated maybe by larger marketing messages and other types of norms that are part of everyday life. Or another way we might look at it is the government as well. And we're no stranger to what our tax bills look like. And for many of us, tax can be our largest expense, but it requires planning to manage this expense as much as possible. And of course, within legal limits. We're going to touch on tax a little bit later on. So, with your cash flow in your business and whatever stage you're at, wherever you're at right now, wherever you're headed, we really need to make sure we have a laser focused plan that's accounting for every dollar. When we look at our cash flow, however, I'm going to have two charts here though. And the first one is, well, that's a salary income. We know what's going to happen twice a month or every couple of weeks. Maybe a little bit more predictable in terms of how we manage things, but I would wager that maybe more of us could relate to the chart on the right, and that's what the income might look like for a person earning the same thing in a year, but on a commission basis. We know we've got slower times, and we know we have peak times, and I would argue in a regular income stream like this deserves more planning maybe than something that's a more predictable salary income than we might see for some other individuals. So much more importance to look at that. How often maybe do you step back from it all and note how many different types of expenses you might actually have? And if we do this exercise, we might actually feel sometimes it's death by 1,000 cuts. When we step back and see, well, I'm paying for this, I have to pay for this, well, it's the cost of doing business. And we've heard that before. And while that's true, there are controls that we can take of our costs of doing business to make sure that we're monitoring them. They are really what they should be within reasonable means, and we don't let them get out of control. So we should earmark which one of these are maybe fixed expenses where, that's probably going to happen on a monthly or regular basis, and I don't really have a lot of control. I have to pay those, and the amounts are what they are. But we also probably have variable expenses that we are incurring as well. And that what I would say is something we have a little bit more control of. But again, looking at them like that, what systems have you actually implemented to monitor, manage, and control those expenses? So let's look at an example of something that you could do or implement that I've seen work very well. First of all, this is going to be one of the least sexy or fun slides I'm going to have in this presentation. That's because this work isn't necessarily fun or sexy to do sometimes. I wish I had a visual of the new iPhone or the Tesla Model 3 here, but that's not really going to help us for purposes of our conversation. So if you're a solopreneur, entrepreneur, and you don't have access to bookkeeping and accounting services, here's something you can do to organize things for yourself. So looking at your expenses, I've categorized them here. So on a fixed basis, I know I've got my typical cell phone, I've got insurance premiums I have to pay, maybe I have a membership to certain associations. I might be paying for an office space and a vehicle and things like that. So I know, okay, on a monthly basis, I know that these are going to be there, and I know they should be the same amount every month. Then I've got my variable expenses, everything from advertising to gifts and promotional items that come and go. Of course, we're going to restaurants and either taking out colleagues or clients, different office expenses. Maybe you're, in addition to your vehicle, using taxi and Uber on a case-to-case basis as needed if you're in a rush. So again, these are just example numbers just to give you an idea of what this exercise might look like. So on a monthly basis, I'm looking at $18.59. At the end of the month, what I could do is, okay, now I'm going to compare what I actually paid in those expenses after I've incurred them. So maybe at the beginning of every month, I look at last month and I'll look at my fixed expenses and say, all right, everything's good here, except, oh, why did my cell phone bill change? I don't know if anyone else has had experience with your mobility provider and maybe a billing resolution or a charge you shouldn't have been charged for. The best thing to happen to the telecom companies, I think, is automatic bill payments on your credit card. Much harder to notice when these things happen. And we might just be like, oh, our bill was higher this month and not really give two thoughts about it. But in this case, maybe we had a promotional pricing plan that expired. Or if you're like me and every time you go to White Rock, you get charged roaming charges because you're too close to the border. And my bill says I was in the United States for a couple of days where I actually wasn't. So I'm sure other people have experienced that as well. So a little trigger there, or maybe if our membership has changed or things like with the fixed expenses, if something's wrong, chances are somebody else is to blame and we have to do something about that. The variable expenses, different story. I have a budget set up for what my variables are, and we can see some different numbers there. Maybe those aren't going to quite as closely match what I have budgeted. So in the rest of my spreadsheet, and you could set this all up in Cell to be automated, I've got these cues that are going to give me an indication of when I'm over or under budget. So I see pretty quickly, yeah, my Cell wasn't right there. I'm under on my advertising, gifts and promo, maybe things were slower, but oh, I went $200 over on restaurant and office, and you know, I maybe was looking for a little too much convenience and used taxis and Uber a little much. So I can see, okay, for that month, I was over $270. Without doing this, 270 might be 350 the next month, might be 500 the next. This is that slippery slope where those variable things can get out of control and really start eating into our pockets. So with a system like this, you're again going to have a laser focus. You're going to know every dollar that's going out and where it's going to. And if something's not right, you have the ability to change that for yourself. One more not so fun slide, and I'm sorry if you're on a smaller screen, but I wanted to drive a point home here. This is on a personal expense consideration, and be honest with yourself. Are you this detailed and meticulous with your finances and your expenses? If this is an area of focus right now, are you paying this close attention to all of the spending that you are doing right now? And this is an exercise that I've had a number of people go through, and it can be very insightful. You'll see the white columns there include both estimates and actuals. And I have people go through this and say, what do you think you spend in each of these items on a given month? So on average. And then I say, when you're done that, now we pull out the debit and credit card statements. Now let's put the actual amounts in there. So let's do the homework. Let's go through those line by line, dollar by dollar. Compare what you thought you were spending to what you were actually spending in each of those months. And guaranteed there will be surprises and there will be learnings and insights from this. But again, maybe not something we necessarily invest the time to do, can be a lot more involved. Of course, there's a lot of electronic resources out there to help you with this. Some apps you can use are something like Mint. QuickBooks actually has some pretty good tools there. Depending on your financial institution of your credit card, you can use spending alerts on those systems. or you can set those up right in within your checking accounts there. There's no, there's no shortage of digital tools to help you with this if time is an issue. So seek those out. Note with any of those apps that often they're asking for access to your banking information. So depending on your personal comfort level with privacy, be really weary about those. As we know, breaches are a fact of life now, and consider that we might be exposing ourselves to some of those things. Now, if we're looking for some, or maybe some little quick wins and different things that we can do, and here's what I've noticed some people are utilizing over the last little while here. Getting back to the cell phone plan, if you're in a more premium plan, can you, knock yourself down to something a little bit more cost effective? Maybe you don't need the premium data, unlimited data right now if you're not locked into a contract and you can do something. Changing your credit card is another one that can be quite useful right now, considering interest rates that are attached to them. We all like points, we all like travel rewards, we all like vacation insurance. But sometimes at a 20% interest rate, if you're carrying a balance, unless you're paying it off every month, that's one thing. But if you're carrying a balance, that's not a great place to have money sitting right now. So the financial institutions will switch you, from one of those premium cards to maybe a more basic card with no annual fee. Maybe it's going to have an interest rate more around the realm of 10 or even lower. They don't ask for a credit check or anything like that, so you're not going to get a ding to your credit score. And you can basically, if you're carrying credit card debt, knock your interest expense in half. They're also entertaining annual fee or interest forgiveness. So maybe even if you are paying off your card regularly and you got dinged with that annual fee, I've known people have had success in calling their credit card companies and just having that right out waived. So you can look at that, or forgiving interest for a month has been something else that they might offer for an alternative. I've even seen some of the card issuers give transfer incentives, where if you're transferring your balance from one credit card to another, one of them was offering 10 months, 0 interest. There's some stipulations around that, but if you could take it from 20 to 0% for 10 months, a lot more of the payments that you're making there are going to go towards paying off the balance and not just paying off interest. Other broader financial relief programs, I'm not going to spend a lot of time here. I think by now we've been exposed to some of the news and the help that's out there. The Canada Emergency Response Benefit, the BC Benefit for Workers, that was the one-time payment, the mortgage deferral options. If maybe you're out there and still unsure if you qualify for some of these or whether you don't, reach out. We can have those discussions as well, but I won't spend too much time on that. So as an action item here, wherever you're at, try to lower your expenses wherever you're possible with some of these considerations. And maybe, we're all friendly but competitive people. Maybe challenge a colleague to do the same thing along with you and say, hey, can you? I bet I could decrease my monthly expenses by $300 before you can. So maybe put a little bit of competitive spirit in there. Or even from an accountability partner, and even not just in finance, but I know in business, particularly if you're, an entrepreneur on your own, sometimes you can feel like a bit of an island. Having someone even just as an accountability partner who's holding you accountable for the things that you say you're going to do by the time that you're going to do them. And I've noted a lot of people have started to do that work during this isolation and pandemic, that they have a accountability partners that they're talking with once or even twice a week to make sure that, if they are working on their business, they're actually delivering on the things that they said they're going to do. So do with that as you will. So for the cash management then, so, review your budget and expenses. What's your income? If it is based on something like the CERB, then that's what you're working with, and that's where we have to go from. Let's look at our expenses, address that shortfall. That might mean dipping into savings, even if they're registered like RRSPs, that might be fine. Debt or lending is okay, but let's be careful and mindful about how we're doing that. And then as things change, of course, revise. So having that plan. Now, moving away maybe from the expenses and the cash flow, let's look at, how are we, actions that are actually generating income. So I don't know if how often we go through an exercise like this, but if we look at what are my costs of doing business? What are my fixed expenses in a year? And, how many transactions or home sales does it take me to meet those costs of doing business? So if I look at it at an annual expense, okay, so I put out this much in a year, I make on average this month from a transaction. So that's going to maybe give me my break-even target. So how many of those sales do I need to have to make sure that I am making my expenses back? So maybe we could do this work back schedule where, one home, one sale, one transaction, that's going to come from 3 qualified appointments or meetings with some serious buyers. I know that if I get 3 of those, I'm probably going to have success in a transaction. I can probably maybe find those 3 people from 20 good solid leads. Again, these numbers are just for example purposes. Your numbers might look different. This is the formula should be the same, but the numbers are going to be a bit different. And then maybe how do I generate those 20 leads? Well, I need about 100 exposures to new people from a different variety of sources. So if I know I need to sell 3 homes to meet my expense obligations, then we just do the math and say, okay, I need to get in front or get referred to at least 300 new people, which is going to drive down into B3 transactions. So where do each of these new email addresses or names or points of contact come from? Break out those targets now into the different areas where you can get leads or business from. So do you have a target for yourself that says, okay, this year I want to have X number of leads or appointments as a result of email, online, social media marketing? I want to have X number of leads that come from referral business from referral partners. So this might be things like mortgage brokers, contractors, interior designers. In a year, how many pieces of business do I want to come from those different sources? How many referrals do I want from current or past clients? Do you have a goal attached to that? And with that, do you even have a process in your practice that actually allows you the opportunity to ask for those referrals to other qualified buyers? So it's about putting those systems in place to make sure that we're not only, of course, meeting our expenses, but now hitting our revenue targets. So, beyond the expenses, so what's my target profit for the year now that I've met my expenses? So whatever that is, and divide that from the average commission. How many home sales does that take? How many new points of contacts does that require? And then filtering that out into electronic leads and referrals from different sources. So there's an exercise that, maybe we've probably heard this before, but maybe we're not doing it in practice. When the things are slower, and we've lived through that right now, and we know what it can feel like when activity is low. We need, and again, I said this maybe isn't going to be the last crisis that we're going to experience. Do we have maybe 3 or even 6 months of those business expenses set aside? Do we have them on cash? Remember, cash is queen. Do we have cash aside to make sure that the business can survive? Do I have cash on hand so I can survive personally and pay my personal expenses? So maybe should that be a starting point, a priority for some of us moving forward, that we actually have those types of things in place for us, that we can weather that next storm that's going to come on. So that in itself can be a very big project to take on. So another action item to consider there for ourselves. So we're going to move on from cash management now, and I'm going to get into risk management. And we've looked at a couple categories of risk. At large scale, I think we're quite familiar with what that is right now on an economic or pandemic scale. We know what that feels like. But with cash flow being paramount to any successful plan, so is the risk planning, and there's also going to be personal scale events that are going to happen. So with large scale risk, we've seen that the world can come to a grinding halt. With personal scale risk on an individual scale, only we come to the grinding halt. And the rest of the world goes on day by day, or it's like nothing else happens. So this is where we are maybe a little bit more on our own to weather that particular event. And, this is an area of financial planning that I'm particularly passionate about, as in, I've seen it firsthand and within my immediate family when a very unexpected event can happen. And I can tell you that nothing makes a difficult, tragic situation worse than adding financial pressures on top of it. So with anyone that I work with, I really do encourage that we seriously consider some of the what ifs that can happen to us, not just for purposes of taking care of ourselves, but also taking care of maybe the people that depend upon us along the way. And we're going to look at this type of risk in a few different categories. And again, taking some of this time right now, do a self-audit on yourself. If something, getting back to the emergency fund. So if we know what can happen if we can't work, money doesn't come in, bills need to get paid. Or if we have on an insurance basis. So if I was unable to work due to a health condition, whether that be some injury or illness, what is my insurance or what does my income replacement look like in that type of scenario? And it's an interesting exercise to get to have us look at our own careers or our income in this light. So a quick simple chart here with age down the left side and some current incomes across the top. So someone age 40 right now who's earning $90,000 today, if they work till age 65, they're going to earn over $3 million. I'm including an adjustment for inflation here year over year in growth. We know that won't stay level. But maybe we don't necessarily think of ourselves as earning that type of much money over the course of our careers. And that's the dollar value of us getting up every day and going to work and putting money in the bank account. So that's the dollar value attracted to that activity that we do. And is that something worth protecting? And I'm going to pick on cars here again. If we have a $50,000 car and we're paying a $3,500 annual insurance premium to make sure that car is protected, well, I know I have a $3 million asset that is my going to work. What's the annual premium I'm putting towards protecting that as an asset? So, think of a money printing machine that's sitting in a corner somewhere in the house of where you live. How much money would you put away a month to insure that machine if you knew it was going to spit out $3 million between now and the day you retire? I think the answer would be more than zero. So that's a way that we could actually look at a long-term disability plan for ourselves. That we felt what 3 months of no income can look like. Well, what if that became 9, 12, 2 years, or even a much more indefinite amount of time? We know that would probably be a pretty difficult situation, not just for ourselves, but our household. So making sure that we are taking a pretty serious look at an income replacement plan in the form of long-term disability. Beyond ourselves and getting back, who depends on you? So I have worked with a lot of clients who have just finished working with a realtor like yourselves. They've bought their first home, or they've upgraded and bought a bigger home because they're expecting their first or second child, and the mortgage obligation has grown, and they get thinking, I should probably be doing something here to make sure that my family is taken care of. And this is the life insurance conversation. So we know we have some immediate final expenses, maybe accounting and legal, but the large chunk of it being a mortgage owing. Maybe we want to make sure there's education money as well for when our kids grow up. So I'm putting an example of a cost here. $40 a month. That is a life insurance policy guaranteed for 20 years that covers off $645,000 of obligations. So, and that's roughly for just around 35 years old. So just an example cost there if you're interested. There's a lot of different ways you can get different insurance quotes for yourself. Something we can discuss as well. So again, have you looked at a life insurance plan that takes care of the people that depend on you? And for a lot of us, maybe it's not just our spouses or children, but we've heard of the sandwich generation. if any of us potentially have an aging parent that we might need to take care of. You know, for better or worse, these long-term care facilities have been in the news lately. So this has been a lot more top of mind, particularly for people lately, as those stories have come to fruition. So again, you know, are we planning really holistically for all the different people that we might need to consider? One other piece to look at in terms of our own health, and that is, it's similar to life insurance conversation, but something happens and we're still here, and severe illness and examples like cancer, heart attack, stroke being them, is that there's a financial impact of those things as well. While we do have a great healthcare system that largely takes care of a lot of the direct costs of treatment and things like that, there's no shortage of articles and research papers that show that people will experience out-of-pocket expenses and financial stress if you're dealt with some type of major health event or something of that nature. And whether that be, you know, covering off a year of expenses and putting some money away for other needs, or knowing that, you know, I might have some additional drug costs associated with an event like that, that we can put an insurance plan around covering off that event. A bonus with this type of plan you're not going to find in your auto insurance is, if you never make a claim on things like these, you get a full refund of all of your deposits at age 65 or another time after. These can also be structured to address long-term care needs in the future as well. So some pretty interesting things that we can do with those types of plans. Investing. The golden question: what's the best investment right now? Well, my first response to that question now, and it always has been, is what's the goal? What are you saving for? Is it, you know, is it retirement? Is it first home? Is it a vacation home? Is it a whole host of other things? So what the investment is going to come later. We need to determine what the actual goal is with the money, and return is not the only factor for a successful savings plan. We've heard the phrase time is money. Well, this is an example by the numbers that time really is money. We could put away $4,000 a year for 25 years. I've in total put away $100,000 over that time. I got a 5% rate of return. I end up with $190,000. Take the next person who waited 15 years later and is now doing 10 grand a year, put it away for 10 years. They also put in $100,000. They got double the return I did at 10%. Still only ended up with $159,000. So time is as big a factor, if not a factor, on terms of a success of a savings plan. So let's not always just get so caught up in focusing on a rate of return. As we are in some volatility right now, there are a couple of different theories or approaches that we can take. One such approach is something called dollar cost averaging. Really briefly here, what it does is, rather than putting lump sums away occasionally, we spread out our contributions on a more even basis. And particularly like ourselves, where we have fluctuating income, sometimes we go, yeah, you know, I'm going to make a contribution when that money is available later on. Well, sometimes later on doesn't happen, and we need to maybe be a little bit more mindful of putting that into our processes or even into our budgeting. And what that can do for us sometimes in this example is, you know, if we look at week one, I invested $100. I got the unit of the investment I was buying was $10 a unit, so I bought 10 units, pretty straightforward. But you notice in the weeks where the cost of unit was lower, I bought more. We've heard of buy low, sell high. Well, this is a buy low, buy less high strategy, so that when the cost of the market or investments are a bit higher, you can see I'm buying fewer units in week 6 to 7 there. On the other side of things, I'm buying more when it's below the original threshold. And over time, what that should do is average out that you're actually purchasing units at a lower average cost, rather than, you know, if I put all my money in something like week 6, we know what my cost per unit would have been at that time, and maybe it doesn't make my my investment returns look as good considering what I paid for them. Another piece that's not widely talked about and can be really useful, especially for a more advanced investment plan, is something called a guaranteed investment fund. and how this can actually help out in volatility. So this is a vehicle that looks at not just return on your money, like getting returns, but making sure return of your money. The closer we get to retirement, this becomes very paramount for a lot of people, particularly during a time of volatility, and that we get a return of our money. And this is something that would probably warrant a more thorough conversation individually, but basically in something like your typical mutual fund, in this individual's case, if they started with a $500,000 investment at the beginning of this year, we know what happened to the markets come March. We had a market correction there. Maybe this was only worth $425,000 because the market went down. Now, this person passes away, they leave this money in their will and estate to some beneficiary. Well, anything that goes through a will and estate is subject to the probate process. That's going to include some legal fees, accounting fees, the actual probate fee charged by the province, which in BC is 1.4%. And typically in an estate plan, we have an executor who's carrying out our wishes who also need to be compensated. So if we look at that original $500,000, we're only leaving $398 to our beneficiaries. Guaranteed investment fund works very similar to a mutual fund. It can be a very actively, aggressively managed portfolio that can do a lot of different investment strategies, but it's got a bit of an insurance component wrapped into it, basically saying if something happens like you pass away, we're going to guarantee that the original money that you put in is preserved, and that will transfer on to your beneficiaries. So in an example like this, yeah, the market value is only $425, but this type of investment falls outside of an estate, falls outside of the probate planning process. We don't need to get reduced by all the different fees that go along with it. And our original $500,000 is preserved because of the way the investment was structured. That's a difference of over $100,000 in estate value for this person's particular case. And a will is private property, is not private property, it's public. You can go to City Hall and request copies of wills and see them. The probate process in BC takes 12 to 18 months. So not only was the money lower, it took over a year for perhaps our beneficiaries to access that money. Not the case in the guaranteed investment fund. It's private, passes outside of the will. And because this is an insurance wrapper or element built into it, it's a beneficiary that's paid within about 10 business days because it's a paperwork filing. So for some investors, this might resonate much more effective for yourself than a traditional mutual fund arrangement will. We're going to finish off with our favorite friend, tax. Next to housing and shelter, tax is likely one of our biggest expense items. So as I mentioned before, it warrants specific attention. Back to basics for some of us, but I know it's easy to slip. Keeping receipts, recognizing what it is we can actually deduct and not scrambling at tax time. So again, apps like Expensify or QuickBooks or other types of things can do it for you, or if you're more hands-on, set a time. A lot of business owners I talk to, this is still something that we struggle with over how many years we're in business. So, let's recoup every dollar that we can. RRSPs, you're probably not a stranger to those. We know that that's a great tax management tool, a way to reduce our taxable income, way to plan for retirement. But it's also there for some of us as a way to fund our first home purchase through the first-time home buyers plan, or there's the lifelong learning plan. You can access RSPs for continued education down the road as well. So just some simple things to think about there. When we get to the point of considering incorporation as well as a tax management and looking at a personal real estate corporation, so that can also be a little bit more of an advanced or aggressive tax management strategy. And maybe what are some of the costs and benefits of doing that? Well, the benefit of that is less tax. We know that the money coming in can be taxed at a lower rate. The 12% tax rate is what gets charged to small businesses generating less than 500,000 in BC. So we like that. We could also structure it where we could appoint another shareholder or owner of that corporation. They have to be a non-voting shareholder, but they're still going to be eligible to really receive dividend income out of there. as a way for you to actually do some income splitting practices within your household and reduce that tax bill. What are some of the things you have to think about? 2 sets of licenses for yourself, for the corporation. You're going to have more accounting and legal expenses. And requesting, if you're going to do any kind of actual investing, we know that the legal requirements around a personal real estate corporation don't allow us to do a lot of investing within that entity. So now we're going to have to probably introduce a holding company or another incorporation if we're going to be looking at buying some investments or other properties, and we'd like to do it in a corporation as well. So there are benefits on a tax basis. There are costs associated with it. That's definitely a conversation to have with your accountant if you're getting close to that point and you think that that's going to be beneficial for your situation. So we've gone through a lot. Wrapping it up, I think, if there's a theme or takeaways, what is it you're working towards? Is it a focus on debt, a home, a second home, a vacation home, growing your business? What's the plan? What's the effort that you're putting into that right now? What's your blueprint for success? Like I said, when we're on the other side of this, how are you working to set yourself up and differentiate yourself and to be as competitive as possible? When we're setting goals, like to say, making more money isn't itself not a goal, it's a means to an end. Looking at an actual, a goals-based investing approach, not something that's focused on return, but we're focused on time. What are the resources I have right now? What's realistically possible? And don't just think about the finances in terms of just cash or investing in isolation. We've seen that we have to consider things around tax, insurance planning, and estate planning. So wherever you're at right now, if you have one goal, if you have one, have two. If you have two, have three. Set yourself up, putting in the work, and you're not alone is the good news in setting these goals. So much like you would say to a prospective client, there's value in working with a realtor, a professional who knows what they're doing. This is a chart from a research piece that was done that looks at households that don't work with a financial planner or a financial advisor, and compared that to exact same households with same income, same demographics that do work with a planner. You can see that over the years, the amount of financial assets held by the homes that do work with a planner are more than the ones that don't, and that can be considerable. That can be a considerable more amount of investments or just other kinds of assets or wealth compared to the other people. So I encourage you that if you haven't engaged, you can reach out to access some financial advice. So to sum this up, budget, we talked about that. Be mindful of expenses, control everything that you can, have that laser focus. Challenge someone, have an accountability partner. Emergency accounts, if they're not there, make that a priority. Consider yourself, your own individual crisis management, taking care of yourself, those that depend on you. Invest with care, educate yourself as much as possible, explore different options, know what's actually meeting your needs. Be mindful of tax and how the different ways you can plan for that. And above all else, have a goal. What is it you're working towards? I am absolutely thrilled that all of you joined us today. Thank you so much. I hope you found at least one thing that you could take away from here. As I mentioned before, here's my contact information, email, or a phone. Reach out if there's anything you want to chat about. I'm happy to help. And with that, I will pass it back to our esteemed MC, Josh Bath. Thanks very much.
Barry, thank you very, very much. That was fantastic and beyond informative for me. We are now going to open up the Q&A section, and for everyone watching, just take a look at the bottom of your screen and you'll see 3 icons. One says participants, the other says share screen, and the one you'll focus on will say Q&A. So for anyone who has a question that they'd love an answer to, please put it right in on there and we will begin. Right now, Barry, you're getting a lot of praise and thanks for the information you've just shared.
Great.
I have a question for you. You brought up a really cool concept around competitiveness in terms of expense management. So if I want to get competitive about reducing my expenses, but I don't have that budget spreadsheet that you have, would using my bank statement and my Visa statement suffice? Would that work?
Oh, absolutely. And, in financial management and sometimes getting down to the basics of it, sometimes there's the work itself, but it's the interface of how you do it. And how does that work for you? Are you a tech savvy, on the mobile, everything's an app? Are you a bit of an Excel geek like me, where you get excited about building yourself a spreadsheet? Are you a paper and pencil type of person? You know what I mean? So if it is actually printing off statements, sitting down at a table, if that's something that's comfortable for you, if that's what's actually going to get it done, then that's the way you have to approach it. Where, there are, like I said before, platforms like a QuickBooks or a Mint, they'll connect to your bank accounts and they'll do that for you. It'll be like, it'll pull the expenses, categorize them, give you the pie charts and that type of thing. If you're more tech savvy and you're comfortable with using those types of platforms, then go it that way. But whatever the approach is, if you're not tech savvy, don't use the technology solutions, right?
Okay. Lorna's asking, what is the financial threshold to consider before becoming a PREC, a personal real estate corporation?
Yeah, that's a good question. So incorporation in general, typically what you are looking at as a threshold is, am I generating more income than I need for my business and personal expenses? So when you get to that point, be like, I'm covering my business expenses, that's all taken care of. My personal goals and expenses are being taken care of. If I'm generating excess cash above that threshold, that's usually the biggest indicator for someone to think, okay, now it's time to incorporate, because I know the more that I earn, I'm on a marginal graduated tax rate basis. So, on that next dollar I'm earning, now it's maybe getting taxed at 30%. I go higher and higher, maybe now I'm getting taxed at 40%. So I'm kind of, hey, wait a minute, I'm being punished for being successful and doing better here. So for some people, they're like, wait a minute, I need to incorporate, because now when that money comes in, I know it's going to be taxed at 12%. I can take out what I need for my personal expenses. I'm going to leave the rest in the corporation, shelter that from that personal income tax.
Is another way of looking at it too, like whether you're earning 100,000 GCI or 250,000 GCI, a PREC could be applicable to either or, but it really depends on how much money in that GCI that you're spending.
Yeah.
Right.
Yeah.
If you're spending all 240,000 of 250, a PREC
Right.
may not make sense.
Right. Yes. Yeah. But yeah, and even at the lower levels and things like that. But again, it's even if you are at a certain point, and the government does change things on a regular basis around taxation, around corporations. So there was actually, when the 2018 budget came out, there were a lot of self-employed people that I noted that even though their incomes were a bit higher, they were using different income splitting maneuvers and things like that, which they're totally legit, but the government came in and said, you know what, we don't really like those anymore. So I know even some people that unincorporated after that happened. So it's, again, it all just kind of depends on, you're right. It's not just an income test thing. There's a few other different elements that it's going to make that decision.
Wonderful. We've got a couple more questions.
Sure.
Lee just asked, what are the tax or estate benefits for a PREC appointing a shareholder? Question.
So the question is, what are the tax or estate benefits of appointing someone other than yourself as the shareholder, is I think what we're...
Sounds like perhaps you're the main shareholder, but you might appoint another person as well, add a person on as a shareholder, Class B shares.
Okay, so when you have, in a personal real estate corporation, because they're non-voting shares, so in a typical corporation from an estate planning perspective, if you have somebody like a spouse, assets can roll over on a tax-free basis. As we know, it's called a spousal rollover position, like a lot of different investments. That can also be the case in a corporate standpoint. Otherwise, if you don't have any kind of either successor or rollover provisions, all of that wealth or the assets in that corporation upon death, from the CRA's point of view, you sold it all. It's all been sold. You passed away. Whereas now the tax is due. Whereas we can sort of defer that tax triggering event if we've structured things with a successor ownership of the corporation, or when we're setting up a holding company, and this is typically where the more focus on the estate planning comes from. We don't want to leave too much of that money actually in our PREC. That could be exposed to a whole bunch of different things. They're usually moving that into the holding company because we're using those assets within the holding company to live longer than our actual working life. The assets in that holding company are going to be how we're going to fund our retirement down the road, because we know our PREC isn't going to last forever, because we are eventually going to retire out of the business.
Okay. Keith is asking, are financial planners in BC fiduciaries generally?
Okay, so we're gonna, there's been a lot of talk about exactly even what is a financial planner or an advisor. Ontario is very much on the forefront of this right now in actually regulating who can call themselves a financial planner or a financial advisor. And where this is heading is that there's going to be, if that comes to fruition in a province like Ontario, and what happens typically in this realm of the industry, what happens in Ontario is usually what's going to happen in the rest of Canada. There might be a lot of people who are calling themselves financial planners who are not going to be able to anymore once this type of legislation gets moving, and people are going to have to be called, either a salesperson rather than an actual advisor. So if you are seeking a financial advisor, I would look for accreditations. I would look for something, like a certified financial planning designation. That's definitely the gold standard in the industry in Canada in terms of actual being held accountable on an ethics basis and an educational basis, and the things you can and can't do. So I know that's a bit of a long answer to the question. So I guess the long answer is no, not all are a fiduciary necessarily by definition.
Definitely an informative answer. Thank you. Rod is asking, for investments, do you recommend mutual funds that give dividends? And what would be the pros and cons of this? And what are the tax rates for dividend income?
Do I recommend a dividend fund for investment? Again, I would start with, well, what's the goal here? What are we investing? What are we investing for? Why is our inclination to start with considering a dividend fund? It can meet certain goals and objectives for yourself. We know that dividend funds usually are built upon really, long-term healthy companies, sort of that we can't imagine life without these types of companies, and they continue to pay strong dividends throughout the course of time. So we kind of utilize those as a, I'm not going to get wild growth out of the stock itself, but I know I'm going to get a bit of, a fairly decent predictable income stream based off their dividend history over the course of time. And yeah, there are tax advantages to receiving dividend income versus if you're receiving interest income. So from a quick answer, yeah, dividend income should have a lower tax rate than if you went into a GIC and put that money there and were earning an interest income off of that type of investment. So yeah.
That question,
yeah, short answer, yes.
that question sounded like it was aimed towards a specific company or one company, an individual company. And I guess if rather than a dividend, if the company took the money back and reinvested it in itself and strengthened its stock, that could also pay itself back in a sort of a different kind of a dividend.
Right, yeah.
Another question came from Baji, is the guaranteed investment fund a living benefit or after death benefit only? Is that also called segregated funds?
Yes, it's also called segregated fund. Yes, also it can be structured as a living benefit as well. So there's two types of guarantees that you set up. One's the death benefit guarantee and one's the maturity or the living guarantee. And you have the option of structuring whether you want a 75% guarantee on your original investment or 100% guarantee on your original investment. And you can sort of pick and choose whether, you know, I like the 100% upon death, but maybe I only want 75% guarantee upon the living side of it because I know I'm planning to hold this for a certain amount of time. And of course, the more guarantees you put, the higher the fee might be for that feature on that segregated fund as well.
Okay. Here's a comment from one of our attendees, just highlighted all the things I've done. I've transferred credit cards to low interest, the cell phone plan, adjusted home cable internet, deferred car lease payment, deferred mortgage payments for 6 months, check with sufficient life insurance, have credit card in notification set, purchased over $100, set up PREC to pay lower taxes, trying to better understand app to record receipts so don't have to stress year end. That's a good one. The shoebox method.
Yeah.
Income splitting is also something I'm learning with my accountant.
Great.
That basically highlights your presentation.
Hey. That wasn't rehearsed, I swear.
No, it's a gold star though for that one. Here's a question for you though. Adelina's asking, what about people with rental income on top of the earning? Is setting up PREC a good idea?
So as I understand, if you have rental income from a property, typically you're not allowed to own a whole bunch of real estate holdings inside of your PREC. That's where the setup of the holdco would be. Now, if you own that property personally right now and you're thinking, well, it would be better to corporately own it. Typically, the advantage comes when you upfront purchase the property, not after you've already owned it. So if you're thinking of purchasing an investment property, typically what we, of course, look at it is I would rather use my cheaper corporate dollars rather than my personal dollars to buy that investment property. That might be an event where we trigger the setup of that holding company. I transfer money from my PREC, transferring assets into the holding company. The holding company is now going to be the entity that owns that rental property. And then the rental income is going to come into the holdco, and we think, yeah, we've accomplished some tax advantages there. A caution in that strategy, though, if you ever plan to sell that property, we've got a double taxation event that's going to happen. Because what's going to happen is if you sell that property and it's inside your holding company, you're going to get taxed on the sale within the holdco, and then if you want that money personally, there's going to be another tax to pay as a flow through out of dividends or whatever to get that cash out. So I've encountered some client cases where they did do that move where they purchased the property within their holding company, and now they're at the point of where they actually want to sell it and access some of the cash, and it's the tax bill they're staring at is quite substantial. So I would proceed that with caution.
Thank you. Listen, everyone, I just want to let you know we're approaching the end of the presentation. We're going to wrap up in about 5 minutes or so. So for anyone with a burning question, now's your time to get it in, and we'll do our best to get to all of them. Barry, we've got a few more questions here. Can you elaborate on critical illness insurance and long-term disability insurance vis-a-vis age 40 years, 50 years, and 60 years? And then is there a big difference in premium, or does it require medical examination?
Yeah, so yes to both questions. So most of these products are structured in a way that they require a medical underwriting process, a health questionnaire. Sometimes might include even fluid tests, like that you would need to go to a lab, get lab results for. They do get more expensive as you age, but with the way some of the insurance companies structure them, once you get in, your cost is level forever. You can guarantee your costs until age 65, or in something like critical illness or life insurance, you can guarantee that cost for your entire life. So it's one of those things where the sooner or younger that you get in, the better. That being said, there's definitely products available and solutions as well, almost at any age, particularly when you're getting into considerations perhaps around, if you're at the end of your career, maybe long-term disability isn't much of a concern, but the critical illness or long-term care solutions are probably going to be a little bit more critical or paramount at a time like that. And yeah, there's absolutely different ways you can access those at those times. Again, there's going to be a cost associated to it, yes, and there will be medical questionnaires attached to those as well.
Okay, thank you. Nav is asking, and actually he's making more of a comment. We can't purchase real estate in our PREC. Yes, that's correct. We need to open a separate corp. Does that corp need to be a parent company under a... And then one follow-up to that. Can we
Josh, sorry, Josh, you froze there. I didn't catch the first part of the question. Sorry.
Okay. We need to, so we can't purchase real estate in our PREC. We need to open a separate corp.
Yeah.
Does that corp need to be a parent company under a separate parent company or tied to the PREC in any way?
What you could set, you don't have to set up necessarily a parent company. Have seen where people just have the whole, they own the shares of the holdco. The holdco owns the and it owns the PREC, and that's where you kind of get that flow through of transferring cash because the corporations are associated. So any method that you can actually associate the corporations, that's where you're going to get that advantage of moving that money from the PREC over into the holdco. So you would likely want to structure it that way.
Okay, sounds good. Another question. I have some cash saved up. Should I invest in a mutual fund or pay down my mortgage?
Pay down the mortgage or invest in a mutual fund. Well, the first thing I would say is make sure, the first step one, if you've got your emergency funding taken care of, great. If you've got enough cash to weather any future uncertainty, check mark there. When you look at, should I pay down debt or invest? You always basically have to look at, what am I paying in interest on the debt? What am I planning to expect to receive as a return on the investment? If you're going to earn more on the investment than interest you're going to pay on the debt, then the sort of general rule is to go the investment route. If you don't think you're going to earn as much on the investment, and it's not going to be more than you're earning or that you're paying in interest, focus on the debt reduction. Would be I would say the simplest way to approach that one.
Bji is asking, can I switch my RRSP contribution to a GIF or a GIF?
Yeah, you can. So that's, yeah, absolutely. So you can transfer, if you're holding an RRSP in a mutual fund, you can certainly transfer that into the GIF structure. Absolutely.
Okay. All right. Salvador wants to know, what is the tax percentage charged to Holdco when Holdco owned property is sold? And will this be a Holdco income tax, capital gain or capital gain tax?
Yep. Yep.
And is there a difference in rates or just the same?
Yeah. So if your capital gains tax, so if we sell the property, if I bought a property for $500,000, I'm now selling at $1 million. I've got a $500,000 capital gain. Right now, the capital gains inclusion rate is 50%. So half of that gain would be subject to tax. So $250,000 out of that $500,000 gain is what's going to be exposed to tax. And that's going to be taxed at sort of whatever the general corporate rate is. So roughly about 50%. So if you look at a $500,000 capital gain, the kind of simple math would be that you'd pay roughly a 25% tax rate. Now, I'm glad you brought that up because referencing the 2018 budget again, and even budget before, the 50% capital gains inclusion rate has been looked at more than one time as a means for the governments to look at how they can increase tax revenues. They received a lot of pushback from that. And felt to leave it alone so far. The capital gains inclusion rate used to be 75%, and it wasn't that long ago that it was, but again, we're quick to forget history. Moving forward, we've seen the spending happen in light of the COVID pandemic. You know, we're going to have to recoup. The government's going to have to recoup some dollars. I would guarantee that they're going to be revisiting the capital gains inclusion rate again, and so we might see that change. So that might have to weigh in on some of the planning that we do in our corporate structures as well.
Okay, thanks, Barry. We certainly weren't able to get to all of the questions. So for those of you that did ask, not to worry, we'll forward those questions along to Barry and he can respond back to you. I just want to thank everyone for joining us today, and a special thanks to Barry Trischuk and Endurance Financial Services for sponsoring and speaking with us today. Barry, well done. You rocked this. Thank you very much. I found it informative.
Great. Thanks very much, Josh.
Everyone.